Good afternoon and welcome to the April 24th, 2024 meeting of the Minneapolis Board of Estimate and Taxation. My name is Steve Brandt. I'm the president of the board. At this time, I'll ask the clerk to call the roll so we may verify the presence of a quorum.
Commissioner Fry is absent. Commissioner Bennett.
Present.
Payne.
Present.
Chugtai.
Present.
Priest-Stinson. Present. President Brandt.
Present.
There are 5 members present.
All right. Let the record reflect that we have a quorum, and I will now offer an acknowledgement that we meet today on Dakota land and the land also held by their predecessors in this space. We will proceed to our agenda, a copy of which was posted for public access to the city's legislative information management system, which is available at lims.minneapolismn.gov. Board members, the agenda for today's meeting is before us. Is there a motion?
So moved.
Second?
Second.
Any discussion? All those in favor, say aye.
Aye.
Opposed?
Aye.
All right, the ayes have it, and the agenda is adopted. Next is the acceptance of minutes from our meeting of March 27th, 2024. May I please have a motion to accept the minutes?
So moved.
And a
Second.
Any discussion? All those in favor, say aye.
Aye.
Opposed? The ayes have it, and the minutes are accepted as presented. Item number 4 on our agenda is the acceptance of public comment. Do we have any public comment? The clerk informs me we do not have anybody signed up to speak today, so we'll continue with the next item on our agenda. Just as a reminder to the public, one may appear at the Board of Estimate meetings to comment on an item on that day's agenda. And you can show up and contact the clerk to sign up. So our first real order of business today is a discussion receiving a presentation of the fourth quarter 2024 financial status update from the City Controller. Mr. Hodges, welcome.
Thank you, President Brandt, Vice President Priest-Stinson, Commissioners of the Board. My name is Lyle Hodges from Finance and Property Services with the City, here to present the financial status report of select city funds as of the fourth quarter of 2023. I will make one note before I begin, especially in the fourth quarter here. These numbers are final in terms of comparing budget to actual performance for departments and funds. However, they are unaudited, so if you look at the city's financial statements in 2 months when we issue them, you will see differences because of accounting adjustments that we are required to make when preparing our audited financial statements. So similar to prior quarters, the city continues its financial recovery from the pandemic. Likely going into 2024, that's a statement that I could probably remove. We are probably nearing as close to pre-pandemic or post-pandemic life as we will see in the financial area here. Last fall in August, Fitch upgraded the city's credit rating to AAA. That's the first time since 2016 that the city has received the highest credit rating from both Fitch and Standard & Poor. Parking revenues are rebounding. They're up almost 15% compared to 2022. Local taxes likewise are up 16.4% compared to 2022, and we are exceeding budget for the third consecutive year. In local taxes, we are also spending our ARPA dollars as designed, supporting the recovery of the pandemic for both public health and economic recovery.
Excuse me, Mr. Hodges. Commissioner Payne has a question.
Thank you, Mr. Chair. I was curious if you had any historical context as to why the bond rating dropped after 2016.
President Brandt, Commissioner Payne, I think, I don't remember all of the context, but a fair amount of it was revolving around the pension obligations. So around that time, the Government Accounting Standard Board had implementation of a new accounting guidance that we had to now start recognizing our share of the state's pension obligation. And for some organizations, and the city was no different, that was a large number. And so 7 years on from that, I think the industry is recognizing that that number, it varies quite a bit from year to year, and it isn't necessarily a great metric of financial performance of an organization to see what that share of that number is each year.
So would I be correct in understanding then that the liability, the foundation of the liability didn't change? It's the credit ratings that maybe started to recognize what kind of risk that liability is and upgraded us as a result of that deeper understanding?
President Brandt, Commissioner Payne, yeah, I think that is a fairly simplified explanation. I'm sure the credit rating agencies might have no answer, but that's my perception of what has occurred.
Thank you.
All right, so moving on to, or continuing on with the overview, the total book value of cash and investments at the end of the year was over 1.2 billion. There was a slight decrease from where we ended 2022. We are continuing to meet both fund balance or net position and cash reserve minimums in all but the funds listed there and for the reasons listed. So in the self-insurance fund, we do have a $141 million cash balance. However, that's offset by a large long-term liability, which is bringing the net position below what we would like to see or what the target is. The parking fund continues to have a cash balance that doesn't meet the minimum. However, as I mentioned, revenues are recovering, and we've also taken the step of reducing transfers out. So we are hopeful that the parking fund cash will rebound to the target amount. And then finally, the sanitary sewer fund is continuing their planned capital spending, but operating revenues will hopefully return that fund back to their minimum target balance by 2024, or in 2024. So moving on to the general fund, this is used to account for all financial resources except those that are required to be accounted for elsewhere. At the end of 2023, the fund balance in the general fund was $210 million. That was an increase of over $36 million from where we ended 2022. I've got a small note there about the unassigned fund balance being $139 million. I'll go into that in the next slide. We are exceeding the minimum fund balance as required by policy, which would be $113.6 million. We had budgeted to use some fund balance in 2023. However, as we see, there was actually a gain. And then we had rollovers from 2022 into 2023 that actually increased that use of fund balance plan as well. And then finally, cash balance in the general fund ended the year at $230 million, which again was an increase of over $35 million from where we ended 2022.
Excuse me, Mr. Hodges. Commissioner Benny.
Thank you, Commissioner Brandt, Chair Brandt. Is it okay if we ask questions as the slides go by? Yep, okay. So, I think I recall, since we had the third quarter report, not that long ago, I believe that we weren't at that 17% target, or the city wasn't at that 17% target, but below it in the third quarter report. And do you know what accounted for, it seemed, I could be wrong about that, but the swing up to exceeding the 17% minimum?
President Brandt, Commissioner Abinay, in the third quarter, I don't recall specifically, but I believe if we were below that target balance, it was probably the cash balance, which we see fluctuate tremendously over the course of the year because most of our revenue comes from something that we collect only twice a year, which is property taxes. Yeah. The actual fund balance is pretty consistent, and we have maintained that above that target for the entirety of 2023.
Okay, thank you.
All right, so general fund, this is a chart that I used in the fourth quarter report last year because at the end of the year is a really good time for us to measure our fund balance. It's also a good time for us to keep in mind what parts of the fund balance are available for use. And so this chart depicts the entire fund balance there, which is 210 million. But then you can see on top, we've got some layers that need to be accounted for. The first one being rollovers. So in 2023, going into 2024, we rolled over budgets totaling 25.8 million. And so we can think of this as using 2024 dollars to pay 2023 incurred expenses. And then the second line there, or section, is representative of the public safety aid that we received right at the end of 2023. So we got $19 million from the state, but that came with a restricted use only for public safety. So again, that comes off the top there. The third part is a reserved amount of $8 million for the settlement agreement. So the settlement agreements will have costs that we want to plan for, and so we've set aside $8 million for that. And then the final part there is the planned use of fund balance that was already programmed into the 2024 budget when the council adopted it, and that was 18.3 million. So when you take all those layers off the top, you get about $140 million in that dark gray section at the bottom, and you can see how much closer that is to that fund balance target line than the full bar. All right, so specifically revenues in the general fund, this graph here shows us revenue by category, and then the table below gives you some more detailed numbers. Highlights include the bottom line. We were about $35 million over budget. We collected $35 million more in revenue than we had budgeted. A big part of that, like I mentioned just briefly, or just on the previous slide, was that public safety aid. That was $19 million that we hadn't budgeted for. All other revenues, the line at the bottom of the table there, includes our investment earnings, which were positive in 2023. We collected 13.6 million more than we had anticipated. So again, a lot of factors contributed to the $35 million difference there, but those are the two biggest. Putting some historical context on the revenue dollars, we can see here.
Excuse me, Mr. Hodges. Commissioner Priest-Stinson.
It's just 2 slides back, and I definitely know you will not have this information queued up, but it would be nice to know for the future when you talked about the $8 million in settlement agreements. One, that's across the board regardless of type of settlement, like that could be police misconduct, that could be whatever, right? That's payment settlements that are made from the city to other people. Question.
President Brandt, Vice President Priest-Stinson, that $8 million is actually specific to the Department of Justice consent decree agreements.
Okay. Is it a regular line? I believe it is around reporting on settlements regularly in our quarterly reports. Like the dollar amount, I think that's a regular number we receive. I would just be interested just to know, especially since the murder of Mr. George Floyd. I'm curious how much there's been increases in settlements, specifically in police misconduct. Is that information that we track categorically amongst all types of settlements?
President Brandt, Vice President Priest-Stinson, those legal settlements are actually paid out of the self-insurance fund, which is reported separately. And we do have metrics to track those types of settlements and their fluctuation over the years and then the variance. If you would like to see that, I'd get that to you after.
Yeah, I'd be interested in, if you would like to answer the question, Mayor Frey, feel free to,
Commissioner
appreciate it.
Frey,
And I would also be interested in just getting the information just to look at it, and it's just something I'm interested to track. Thank you.
Mr. Chair, Vice Chair Priest-Stinson. So I'm sure we do have the numbers that identify the amounts paid out through settlement agreements generally, and we can certainly get those for you. This, I believe, is used differently. The term here is it's how much money we are putting in to comply with the settlement agreement, not how much money we're paying out for settlements. So it's just a difference. I can see how the misunderstanding would have been made.
Yes.
So this is money that we're putting in to do things that are necessary to meet the standards set forth in the settlement agreement. I think I'm right about that.
Right.
Yeah.
Yes, that is very helpful, and it's also helpful to have the other information, being that we know what the multiple impetuses were to having to do a Department of Justice consent decree in the first place. So both are helpful and relevant, and greatly appreciated.
Please proceed.
Okay, so for historical context, in the general fund, we do, on average, over the past 3 years, we've collected just over 100% of revenues. So 2023 was a little bit higher than normal, where we collected about 106% of the budgeted amount of revenue in the general fund. Flipping over to the expenditure side of the ledger, within the general fund, we've got expenditures here grouped by major department, and these departments represent the organization of the city after the recent reorganization. Again, the highlight here is the bottom line, where you can see we were nearly $39 million under budget. And then the major departmental categories, you can see which ones led those areas of being under budget. Within the public safety line, we were over budget, and that was due to, primarily due to some back pay owed to firefighters after their contract settlement. Public Works was over budget again, primarily related to personnel expenses. However, we did recover some of those expenses on the revenue side through charging other departments and other projects. So again, a little historical context for expenditures in 2023. We ended the year at 93.8% of budget. Over the past 3 years, we have averaged about 95.5%, so we were slightly more under budget than recent years. All right, and the next few slides, I'll go through funds by groups, by type. And so the first group we'll talk about are the special revenue funds. This is where we account for and report the proceeds of specific revenue sources. I've got the significant or major special revenue funds listed in the second bullet there. In total, the fund balance for this group of funds ended 2023 at over $400 million. That was a $35 million increase compared to 2022. The cash in these funds combined at the end of 2023 was $458 million. That was actually a slight decrease, or a $28 million decrease to where we ended 2022. Predominantly, that decrease was due to spending down ARPA funds, which we planned for. Okay, and then the next slide shows us a table detailing which funds, or detailing the cash and fund balance by fund. So you can see there which ones saw the greatest changes and which ones stayed pretty much the same between 22 and 23. Okay, and then the next group of funds that we'll talk about is the internal service funds. This is where we account for those goods and services that we provide internally to other city departments. We've got 6 funds listed in that second bullet point. The cumulative net position of these funds at the end of 2023 was about $89.6 million. That was a $6.8 million increase from where we ended 2022. The cumulative cash balance in these funds was $179.8 million. Just a slight increase of 2.3 from where we ended 2022. Internal service funds, since they provide services to other city departments, we have a fair amount of control over their spending and their revenue, and so often we see that they will be pretty consistent from year to year with not too many surprises. So again, this next table shows each fund, the cash, the net position, and how they changed from 22 to 23. And then the last group of funds we'll talk about are the enterprise funds. So this is the most business type or business-like funds that we have at the city. They sell their goods and services to outside parties. These include the utility operations, the parking fund, and the CPED enterprise funds. The cumulative net position at the end of the year was over $1.1 billion in these funds. That net position is really high because these funds contain a lot of our infrastructure assets, and so their net position reflects that. Cash at the end of 2023 was just over 100 million. Again, just a slight decrease from where they ended 2022. And we'll see on the next slide here, cash in these funds is primarily stable. We did see stormwater spend down their cash balance a little bit as part of ongoing capital spending, once again, planned spending for 2023. And that is all I have.
My colleagues have questions for Mr. Hodges? Well, then I will go ahead. Mr. Hodges, I realize you're appearing here today in essence as the city's chief bookkeeper and presenting us this report. And some of the questions I may pose may stray into the area of policy that you don't make, and perhaps the mayor or the council members are better positioned to answer them, or our CFO. First question on page 1, you refer to the plan for ceasing reliance on ARPA after 24. Is my understanding correct that essentially ARPA funds have to be under contract by the end of the year?
President Brandt, yes, the Treasury's guidelines, the Department of Treasury, the U.S. Department of Treasury, their guidelines indicate that ARPA funds need to be obligated by the end of 2024. There's some questions about what obligation means, and so to be safe and make sure that we don't have to forfeit any ARPA funds, as a city, we've made the decision to spend all of the dollars by the end of 2024, again, just to err on the side of caution.
So you won't get into a situation where you have a contract signed before the end of 2024, but the work is actually done and the payments made in 2025. And my question was going to be, is that an accrual basis of accounting then when you book that, or how does that work?
President Brandt, yeah, we still have the details of that plan internally, how we'll operate that will be worked out over the summer here and into the fall. But in the perfect scenario, we would end 2024 with just the final bills that need to be paid in January of 25. And those would be, as you mentioned, an accrual back to 24 and count as a 24 expense.
Thank you. You also reference on page 1 the cash flow issues that affect the general fund by virtue of the source of revenue, portion coming from the state and a portion from property taxes. Question, hypothetically, if the balance in the general fund falls to zero at some point during the year because of the timing of those revenues, is the city permitted to do inter-fund borrowing? For example, could you go over to your friends in the utility department and say, can we have a 30-day loan?
President Brandt, so kind of two answers, and the first one is yes, we do inter-fund loans. Excuse me. So actually, we are required to do inter-fund loans if we get to the end of the year and a fund has a negative cash balance. For financial reporting purposes, we can't report negative cash. So we'll loan money from a fund that has positive cash. During the course of the year, we don't concern ourselves with that because we use a pooled cash at the bank. And so there's never any risk that the city's pooled cash will get to an amount that isn't sufficient to cover our bills, for example. It is possible that fund by fund, depending on the timing of receipts of revenue, a single fund may fall below zero. But again, collectively as an organization, we have the cash in the bank.
Good. Wanted to ask you about the financial report references the actuarial calculations for the self-insurance fund. Could you or somebody in the finance office make those calculations available?
President Brandt, the actuarial report is available. I'm not sure about the nature of some of the information in there. I believe historically, when we release it to the public, the attorneys have had to redact some of that. So I could get you a version, and then we can kind of go from there.
Very good. I appreciate the fact that you included a projection of the end-of-year 24 general fund balance, which was 96.8 million, above the 17% target. Obviously, some of that is obligated, as you showed us in your presentation, but it looked to me that roughly 30 million was above that 17% was not obligated. And I'm not suggesting that we spend it all the way down to 17%, because that might have some implications for our credit rating, which we would like to keep. But I would suggest that in budgeting for 2025, which we know in part because of the mayor's warning of significant consequences from the assessment report, that it will be a difficult budget year, and I hope that some of that money will be looked at to help with that problem. You also mentioned that in the report that the property tax collections are down by more than a percentage point to 97.7%. And I wanted to get a better definition of that. Is that only the collections that are made in the same calendar year? And do we typically increase that percentage as delinquent accounts are paid? And is that then booked back to 2024, or how is that handled?
President Brandt, so that percentage reflects the cumulative amount of all taxes collected in 2023 from any year levied that's still active. And so the actual percentage of 2023 taxes is likely less than that 97.7%, but that's the case in any given year. And so there's actually a table in the back of our annual comprehensive financial report that outlines what percentage of taxes were collected from each of the last 10 levy years. So that's a good resource or a good reference for what you see from delinquent collections in any given year.
Okay. The contingency is largely unspent in 2023. Do you have any idea how often we use even half of the contingency?
President Brandt, I'm not sure. I could go back and figure it out, but I would say anecdotally it's very uncommon for us to use even 25% of the contingency. I would also note, it also ties into your question about property tax collections. Within that contingency, we put 3% of the current year's levy as an offsetting expense to protect us against years where we don't collect 100% of the levy. Okay. So that's also within the contingency, and that would never be spent.
Would greater than that 25% benchmark use of contingency typically be something that might, say, result from a winter like last winter in which we had a number of snow emergencies, or is it more commonly something on the order of a governor's LGA cut, which happened about 2008, 2009, or collapse of a 35W bridge or something of that sort where you have extraordinary expenses?
President Brandt, I don't actually know all the rules around contingency use. I think they're in our financial policies, but typically snow plowing would be something that's operational in nature, and so it wouldn't meet the threshold of an emergency that we would use contingency to cover.
Great. It looks as though the Kelber Catering Commission was renegotiated to take pressure off of them during the pandemic, and that's certainly understandable. Has there been any discussion, to your knowledge, of undoing that now that we are apparently relatively normal in the convention business again?
Sure, President Brandt. I don't know the specifics of that contract negotiation nor the length of it, so it could.
Okay. And the convention center debt was extended by 5 years during the pandemic. Can that be repaid earlier if the special tax collections are rebounding? And what are the pros and cons of that?
President Brandt, I would ask Alan Hoppy, the Director of Banking, Investment, and Debt, for us to speak to that. There's likely rules around early retirement of debt that I'm just not aware of.
Okay. There was a $37 million transfer from the Downtown Assets Fund to the Convention Center, but we had only $13 million transferred to the general fund in 2023, and I think $22.8 million is budgeted for 2024, as you told me in a memo a month or so ago. And I'm wondering if property taxpayers should be getting more relief than that for 2025. Or is the general fund basically the prime shock absorber for sales and special tax collection shortfalls?
So President Brandt, for those two transfers specifically, it's not an equal dial adjustment, but we were using the ARPA transfer in to provide relief to the special taxes transfer in for 22, 23, and 24. And so I would expect in 25 you might see a change in that transfer amount to react to the conclusion of ARPA.
Great. I note that the Target Center is listed as catching up on equipment and improvement projects postponed during the pandemic. Obviously, equipment wears out, but improvements are a different matter. Do you have any sense of why these improvements were not addressed during the fairly large-scale Target Center renovation of a few years back?
President Brandt, I apologize, I don't know the specifics on those. Anecdotally, I know across the city there were shortages that we all experienced in the economy in terms of supply chain issues, labor issues, things of that nature. So it could be a similar answer for the Target Center, but I don't know specifically.
Okay. And Target Center also had to pay increased downtown improvement district assessments. They rose by double-digit amounts in 2023. Did all downtown improvement district assessments rise by an equivalent amount for all downtown property? It just seems like a poor time to be raising assessments on downtown office buildings and other property with occupancy, one-third of their occupancy missing.
President Brandt, again, I feel like I'm striking out here, but I don't know the answer to that
Okay.
one either. I don't know do we know?
Commissioner Fry.
There's a few questions there, some of which I have a clear answer to, others I don't as much. So I believe the first question was about the downtown asset fund generally, and the whole concept was with diminished monies coming into the convention center, the amount that we would normally siphon off into our general fund was reduced dramatically during COVID-19, and I believe at the time we replenished it with either ARPA or CARES Act dollars. Was it ARPA? Well, it doesn't matter. It was we replenished it is the bottom line. And now that money is returning, we're increasing it yet again. There's some flexibility due to the fact that we don't know how much the convention center business is coming back, one. And two, there are going to be needs at the convention center itself for capital improvements. And so we don't want to take so much money that we then have to pay some of it back for the capital improvements themselves. We would rather them use the money that they're bringing in, if that makes sense.
Okay.
So that was the first issue. The second issue, I believe, was about Target Center and assessments, and I don't know the answer to it. Can you maybe repeat the question, and maybe that'll refresh my recollection?
I just was wondering if what Target Center's experience with the downtown improvement district assessment, a double-digit increase, was indicative of a general assessment increase by the district,
Okay,
which
yeah.
I think operates quasi-independently of the city, but it's reviewed by the council, or at least used to be in years past. And I wondered why such an increase at a time when downtown property owners are hurting.
So unless there's an exception that applies that I'm not thinking about, which could be possible, it's a formulaic assessment. that's based on the building itself, and there's some sort of square footage assessment that they take on. And so that would not be out of the ordinary. It would be an overarching assessment that they would all agree to, given that they're part of the Downtown Improvement District, and of course it funds the DID.
All right, and we've already talked really about the 2025 budget picture in the context of the fund balance resulting from the sales taxes. By my math, there's roughly 82 million in ARPA dollars left to spend at the end of the year in 2023, and I'm wondering if we have any inklings of how that will be replaced other than by the increased sales and special taxes in balancing the upcoming budget.
Largely, the amounts that were spent through ARPA were not anticipated to be ongoing. Some of them were contractual agreements. Some of them were one-time expenditures. But yes, there were instances when we used dollars to either backfill gaps left by furloughs or assist with other employment-related matters. And so we don't have as much as, or not even close to as much as, a fiscal cliff as many other governments had, because I like to think that we were pretty responsible with how we spent those dollars. But yes, we still have issues that we need to sort out ourselves as well.
Okay. I'd also like to ask just about something you mentioned earlier, and that is the decision, I believe it was by the Sanitary Sewer Fund, to use cash rather than incurring debt. Can you tell me a little bit about that, what their reasoning was?
So President Brandt, I don't know, again, all the specifics of those decisions, but in any given year with our capital program, there's a balancing conversation around source of funding, whether it's best to use existing cash balances or issue new debt and pay it off over time. And so, again, all of that is also colored by project timing, expenditures that are incurred at times that weren't expected, delays, acceleration, things of that nature. So I can't speak specifically to it, but all of that goes into those decisions.
Okay. I just want to remind my colleagues, and especially those who weren't here in 2022 on the board, that I did propose that we front load our debt, move some of the 2023 debt to 2022, and shift cash backwards so that we could avoid the impact of the increase in interest rates caused by the Federal Reserve. And the board, in its wisdom, decided at that point not to pursue that course, but I'm glad to see that some folks are using cash to avoid borrowing in this climate. Thank you. Are there any other questions? Okay. I guess that means I've exhausted you, and we can receive and file this. Thank you, Mr. Hodges, for your presentation. Our next item of business is listed as announcements because I couldn't think of anything better to put on it. I wanted to, first of all, make sure that board members knew that the next meeting on May 8th is canceled for lack of agenda items. And I also wanted to mention that I have been in contact with the Public Housing Authority director, asking him, asked him actually several months ago now, whether he could get back before us to present on how the levy that we authorized for 2024 is being used. And he expressed willingness to do that and suggested that we wait until the middle of the year. And we have two meetings in July on the 10th and 24th, and I just wondered if one date would work better than either of the would one date work better than the other for board members?
I would prefer the 24th, otherwise I would be missing that. I'll be on a business trip to Alaska.
Thank you for that input. I will see if that works for Mr. Warasami, and we will see no further business to come before the board, so without objection, we will adjourn.